Here is something most people never consider. The stock market does not crash because something goes wrong. It crashes because for a long time, everything went right. And right now, three things are happening simultaneously that have only lined up like this twice in the last 100 years. Once before the dot-com collapse, once before 2008, and both times almost nobody saw it until it was already over. This is not a prediction. Predictions are for people who want to sound smart on the internet. This is a pattern, and patterns do not care about your optimism. So let's talk about what is actually happening. The first warning sign is something called valuation compression, and it sounds technical until you understand the analogy. Imagine you walk into a store and a bottle of water costs $12. You buy it anyway because you're thirsty and everyone else is buying it, and the guy behind you just paid $15. That is the stock market in 2024. Prices have become untethered from the thing being priced. There is a metric called the CAPE ratio, the cyclically adjusted price-to-earnings ratio. It was developed by Nobel Prize-winning economist Robert Shiller, and it measures how expensive stocks are relative to actual corporate earnings, smoothed out over 10 years to remove short-term noise. Right now, the CAPE ratio sits above 36. For context, the historical average is around 17. The last time it was this elevated for this long was 1999, right before the NASDAQ lost 78% of its value. Not 7.8, 78. Now here is the part people always argue about. Valuation is not a timer. It does not go off on a schedule. Markets can stay expensive for years. They did in the late 1990s. They're doing it again now. But here is what valuation compression actually means. When the reset comes, not if, when, the market does not just fall back to fair value. It almost always overcorrects below it. That is how fear works. That is how it has always worked. The market does not take the elevator down. It takes a trapdoor. The second warning sign is quieter, almost invisible unless you know where to look. Credit is cracking. Not dramatically, not in a way that makes headlines. It's cracking in the way that old pipes crack, slowly, under the surface, until one day your kitchen ceiling is on the floor. Here's the mechanism. When interest rates are low, borrowing is cheap. Companies take on debt, they expand, they hire, they buy back their own stock to push prices higher. Investors see rising prices and pour more money in. The cycle feeds itself. Then, rates go up. The Federal Reserve has kept rates at a 23-year high, and most people looked at the stock market still climbing and said, well, it's fine. The economy absorbed it. No big deal. But debt does not reset immediately. It refinances, and right now, trillions of dollars of corporate debt, money borrowed when rates were near zero, is coming due for refinancing between 2025 and 2027. Companies that borrowed at 2% are got to refinance at 6, 7, sometimes 8%. That's not a minor adjustment. For a company carrying $10 billion in debt, that's the difference between paying $200 million a year in interest and paying $700 million. Some of them will manage, some of them will not. And the ones that will not, they're currently in your index fund, quietly waiting. The credit market is usually boring. It's also usually right before the equity market catches up. Right now, credit spreads, the gap between safe government bonds and what riskier corporate bonds pay, are starting to widen quietly, slowly, like old pipes. The third warning sign is the one nobody wants to talk about because it implicates everyone in the room. The S&P 500 is called an index. It's supposed to represent the broad American economy, 500 companies, a diversified picture of where things stand. Except right now, roughly 35% of the entire index is concentrated in just 7 stocks, 7 companies: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Tesla are carrying the weight of what is supposed to be a diversified market. When you buy an S&P 500 index fund, the thing that every financial advisor calls the safe, boring, responsible choice, you are, without realizing it, making a very concentrated bet on a very small number of companies. And here's the uncomfortable math. If those 7 companies correct by 40%, which NVIDIA alone has already done twice in the last 4 years, the index drops roughly 14% before a single other company does anything wrong. The illusion of diversification is arguably more dangerous than no diversification at all, because with no diversification, you know the risk you are taking. With the illusion of it, you don't. 3 things in alignment: extreme valuation, credit stress building beneath the surface, and historic concentration hiding inside what looks like a safe portfolio. None of these things alone causes a reset. Markets can carry 1 flaw for a long time, 2 flaws for a shorter time, 3 flaws stacked on top of each other in a high-rate environment with geopolitical instability on 2 continents and an election year that has already produced policy whiplash. That's a different kind of risk. The market is not a thermometer. It does not measure the economy. It measures the collective confidence of everyone participating in it. And confidence, once it starts shifting, does not shift gradually. It shifts in an afternoon. Ask anyone who was fully invested in February 2020 or October 2008 or March 2000. The move that changes everything doesn't telegraph itself. It arrives while you're checking something else. Not with a recommendation, not with a portfolio strategy. Those are someone else's job. And frankly, anyone who tells you exactly what to do right now is either selling something or overconfident. And in financial markets, those 2 things are usually the same person. If you found out the market was going to reset by 30% in the next 18 months, would your financial life be different tomorrow than it is today? If the answer is no, you're fine. Carry on. If the answer is yes, or even maybe, then the warning signs were never really about the market. They were about whether you were paying attention.